Okay, good morning. Welcome back to Who Charted. I am Dan Russo, CMT, Co-CIO here at Potomac. Hope everybody had a great Thanksgiving. We are going to dive into it. Today is Monday, December 1st. So we are getting started here for the final month of the year, and we are going to do so probably from a position of strength. Looking here at the S&P 500 and the NASDAQ 100, both of these after 3 consecutive weeks of closing below where we opened on the week. We saw these powerful moves higher last week where the opening was the low of the week and the close was the high of the week. To me, that is an indication that people wanted to go home with risk over the holiday weekend. That's a powerful signal. Now, we've been talking about the fact that there was some damage done from a breadth perspective. We'll get to that in a little while. But from a trend perspective, we remain in an uptrend. Both of these are above rising 60-week moving averages. It's kind of hard to get super bearish when that is the case, right? It's these prolonged moves below the 60-week moving average when you want to start thinking about getting bearish. Thus far, that has not been the case. Just a nice steady uptrend for both the S&P 500 and the NASDAQ 100. Moving on now to market breadth. Now, this is where we had some issue last week. We were discussing the fact that the one-year stochastic of the NYSE advanced decline line had dipped below 60%. And what we said in our note was that prolonged moves below 60%, similar to what we saw down here in 2022, or when investors should start getting worried about the market. Crossed below 60% last week and then quickly rallied back throughout the week to close the week above 80%. So to me, that is an indication of strong participation in the market, right? Remember, if we're thinking about the health of a trend, right, we want to see more stocks going up than going down. And we are seeing that. So trend is higher, more stocks going up than going down. But perhaps what was even more impressive to me was NYSE advanced decline volume. All right. Not only do we want to see a lot of stocks going up, we want to see a lot of volume trading in the stocks that are going up. And we saw a powerful move higher. Kind of think of this as the gas pedal, right? If the advanced decline line is the car and it's moving higher, that's great. But where the real velocity comes from is when we step on the gas. Last week, we saw a lot more volume trading in the stocks that were going up versus the stocks that are going down. So if we kind of think about from a trend perspective, going into the final month of the year, which by the way, we'll get to is seasonally strong, we have an uptrend and we had a quick repair, right? In fairness, we wrote a note last week saying that there was some damage under the surface. That damage has quickly repaired itself, as we saw here on this chart and the previous chart. A lot more stocks going up than going down, a lot more volume trading in the stocks that are going up versus the stocks that are going down, so much so that this is now at a new all-time high. So that is something to keep an eye on because this tends to precede the index when moving to all-time highs. Moving on to our intermarket themes, we pay attention. We are old school. We pay attention to the Dow Jones Transportation Average and its 27-week moving average. So for the past few months, we have been grinding higher above the moving average, and the moving average has curled up and is moving higher as well. So is this a great chart? Absolutely not. It's basically been going sideways for 4 years, but it's also not a terrible chart. The grinding higher, I mean, listen, we want to see a strong trend here. We want to see confirmation. We want to see this index making new highs along with the S&P 500. So far, it's not the case, but it's not doing any damage either. We're above a rising 27-week moving average, so we will take that as a positive from our intermarket work and from an intermarket trend perspective. And then finally, we will get into seasonality. We all know the mantra, sell in May and go away. We all know that, November, December, January, February, March, and April are the strongest 6 months of the year. But if we kind of look, November is the strongest of those 6. And last week's late rally actually got us to close in positive territory for the month. So November keeps its reputation as being a strong month. And now we move into December, which also tends to be a strong month. We'll start hearing about things like the Santa Claus rally. The media will butcher its actual definition, but we will come back when it makes sense to discuss it. But for now, let's just assume and point out the fact that seasonals remain in favor of the bulls. So if we're kind of thinking about the market here, the trend is still bullish. We saw a massive improvement in breadth last week from both the number of stocks going up, the advanced decline line, as well as the volume trading in stocks that are going up versus going down. Intermarket themes remain healthy, and we are in the seasonally strongest part of the year. So it's kind of hard to make a really strong bear case in my opinion, especially with that breadth picture improving as rapidly as it did last week. So trend remains higher, confirmed by breadth as well as intermarket themes, and the seasonals are a tailwind. Kind of hard not to be bullish there. So thanks as always for taking the time to hear us out. Hope everybody has a great week, and we will come back to you next week. Have a good day, everyone.